Let's start with gold, and the gold norms, the final norms for the gold loans rather have now come. The standard value at average price of 22 carat gold for last 30 days would be taken. The standard value taken to arrive at loan to valued LTV, of course, continues to be at 60%. The making charges cannot be added to calculate the LTV. The RBI also has given a nod to expand beyond 1,000 branches, though appropriate infrastructure for storage of gold jewelry is something that the banks will have to take into consideration. Also, they will have to verify ownership for gold loan collateral above 20 grams. Also, the loans above 1 lakh to be dispersed via check is what you have seen coming in as the final norms. Let's also get in both then Bhargav Vaidya, and he joins us on our Mumbai phone line to get his cue on what he thinks of these final norms. Bhargav, hi. First of all, how different is it from the draft norms, and how do you think that it changes in sense of the industry workings?
The loan industry, when you take it as a jeweler gold loan, it is something different. But this is loan against gold. It is not going to be much different, because whenever a company or an NBFC was giving a loan to a person, they were keeping a very, very safe haircut. This would legalize it in a very good way. It is only that a small group of NBFCs or some players to give some money to their close associates had used a different yardstick, and to bring the value up, they were adding the making cost and all that. This is a good thing. There is a standardization that how much loan a person can get against his jewelry, and any standardization is very good. Just like you have a specific haircut in shares, there is a specific haircut here, and this is healthy for everyone. We will not have any defaults, which is good for the industry.
Bhargav, would that also mean more paperwork, more trails coming in? Because for every 20 grams and above, you will need to verify the ownership here. And of course, any loan above 1 lakh will go by check.
It has to happen. And at present, if you look at the real NBFC portfolios, the good ones, the majority of loans are below 1 lakh. And for above 1 lakh, paperwork is good. And anyway, you walk into the bank, they were doing this paperwork and you were getting by check only. So it is a good way of standardization, and where some people were running away from banks and going to NBFC saying, hey, I can escape this paperwork, will now fall into paperwork. So this is a little bit of extra paperwork, but a healthy thing for future.
Going forward, Bhargav, do you think all this, the final norms that have come in really would support the industry, or do you think there will more people shirk away from it? Because as you spoke, we have an organized sector and a disorganized sector as well when it comes to gold loans.
I think it will help both. The unorganized sector always was keeping this haircut. They were always giving you 50% or less only. So the unorganized sector's norms, the organized sector is following. I think sometimes we feel that the safety norms which they had were better than what we were having. We have to adopt their norms, and it is definitely healthy for industry in long run. If I just put on my bullion and jewelers friends hat, it is healthy for us also, because everybody is now going to ask a bill and preserve that bill. So in case in future they want to take a loan, they have a good paperwork trail. So it is definitely healthy for industry.
All right, Bhargav, well, we'll let you go at that. Thank you so much for joining us. So that's the view really coming in from the industry. They feel that it is slightly more positive. There's a better trail coming in, and you wouldn't see a matter of cheating being happening there. So in that case, of course, that works well for the industry as well. Let's get in then. Anurag Singh, he's CEO, Technicalera.com, and he joins us on the line from Indore with his strategies on all of these commodities. Anurag, hi, welcome. There, of course, are some policy changes coming in for gold loans, but the prices itself have seen some gain as well ahead of the FOMC meeting. How are you looking at the gold prices trading today?
Well, Manisha, thanks for having me. We have already seen a very big volatility in last 4 to 6 weeks because of Syria and Fed tapering talk. Now the Syria matter really getting over, or rather out of radar for some time. I think Fed taper talks will take really high time when tomorrow QE probably tapering possible from the Federal Reserve to the extent of $10 to $15 billion per month purchase program. So I believe that still there is a pressure, a lingering pressure from both the sides, because, we have already seen that internationally dollar is already seeing wobbly kind of a move, but showing sign of appreciation also. So I still believe that there might be some downside more ahead of the, Fed verdict tomorrow. So I think I advise all my traders to go for a very strict or stop loss shorts at gold on MCX at 30,075 rupees, with a stop loss of 30,225 for a lower side target of 29,750. And in case of silver, it's 50,350 being the selling point, with a strict stop loss of 50,650. My target on the lower side would be 49,550.
Anurag, between gold and silver, which one would you be putting to choose? Of course, you have a sell call coming in, but going forward as we head into the very strong festival season here, the final quarter of this year, how are you looking at prices in slightly medium term?
Well, surely, because prices have already slipped quite dramatically in last 2 weeks. In fact, COMEX gold has slipped by 5% and silver fell by about 10%. So I would say that near about the 1275 odd level on COMEX and about 28,500 on MCX would be a kind of a resilient bottom this time around. So I will prefer to buy gold whenever this kind of a fall is coming.
Fair point, Anurag. We'll let you go at that. Appreciate you joining us with your strategies on gold and silver. Intraday sell call coming in from Anurag, but longer term buying on gold on dips is something that he's advising you to do.